We'll quickly move ahead with our second discussion for today's conclave. The topic for the second discussion is climate finance. For that, I invite our moderator, Ms. Lavanya Ashok, partner Growth Equity Trifecta Capital, and our esteemed panelists, Mr. Neville Dumasia, leader Industrials and Energy, EVA India, Mr. Dhanpal Jhaveri, Vice Chairman, Everstone Group and CEO, Eversource Capital, and Ms. Namrata Rana, Partner and National Head ESG, KPMG, who is joining us virtually for this discussion.
Hi, everyone. Hi. Really excited to be with everyone this afternoon, and much like the world we inhabit, this panel is phygital. We are very excited to have Ms. Namrata join us virtually. Ms. Namrata is Partner National Head ESG of KPMG. And as I go through some of the questions, I'll request the panelists to also shed some light on their background and their views on the topic of the day, which is the role of climate finance, and specifically the role of credit in improving the access various pools and sources of capital that is available to address the climate issue. We're joined today also by Mr. Neville Dumasia. He's the leader of Industrials and Energy at EY. Really excited you could join us. And Mr. Dhanpal Jhaveri, who's the Vice Chairman of the Everstone Group and also CEO of Eversource Capital. So 2 big hats there. Really excited to kick this off, but also with some sobering comments, right? 2024 was the planet's warmest year on record, and with temperatures exceeding the pre-industrial average by over 1.5 degrees Celsius. And this is a problem we face every day. It is also a pressing problem as consumers, it's a pressing problem for companies, and it's a pressing problem for countries. And so coming together to address this is something we're all excited to discuss as an ecosystem. And despite India having relatively lower warming, India's vulnerability to climate change is actually very high because of our diverse geography, as well as our concentrated and dense population. And so variations in warming patterns across regions actually affect us more than many other large economies. And our climate ambitions include aiming to meet our NDCs under the Paris Agreement by 2030. This will also require an annual investment of almost $400 billion. And this is a large amount by any means. If we think forward to 2050 to meet net zero, that will require maybe $7 trillion of investment. And these very large numbers actually translate to small micro investments and actions, and that's what I'd really like to discuss today. So it would be lovely to have all 3 panelists share, in whatever order you choose, your views on the current state of climate finance and what you are working on to address these most pressing problems. So maybe we can start with Neville.
Sure. So very happy to be here. Thank you, Lavanya. And I was just telling Dhanpal, all of the panelists are either present KPMG or past KPMG. All of us have been with KPMG. Dhanpal, myself, ex-KPMG, Namrata is still with KPMG. So good to meet colleagues. But on the climate finance side, I think the previous panel also spoke about it. There is this dichotomy that we face right now. We have a country which is hot, which is really happening right now. Growth is unprecedented. We've never seen this kind of growth before. And this is probably our time, right? If we look at 6.5% growth, it's phenomenal. The issue, the other part of this equation is that, as you correctly pointed out, we also are vulnerable. If you look at one of the global climate risk reports, we are ranked 7th in terms of vulnerability, and saying that what exactly can happen if climate changes or climate adversity happens to an Indian environment.
Yes.
It's not just about the regular floods and stuff like that, but it can lead to famine, droughts, yes, various other issues that happen. And the problem is therefore that at one level you have to see a economy which is bursting at its seams to grow, and at the same time you'll have this paradigm on the opposite side, which is saying that what can really go haywire. If you do consider this into numbers, you will probably have a couple of 100 million people getting pushed into further poverty if climate change comes through in its most purest form, and that's a worry. That's really a worry, and therefore transitioning finance plays a very, very pivotal role. It's extremely important. It's extremely crucial. Places that we are seeing climate transition finance right now is largely in the renewable energy space and perhaps a little bit in the transportation side, mobility. That's right. But I think it's something that is crucial, and it's something that very, very, very here and now and has to be addressed urgently. So that's my opening comments on this.
Lovely. Maybe we can go to the present member of the KPMG Mafia. I feel very left out right now that I'm not part of this group. Namrata, would love to hear from you.
Lavanya, did you ask me something? Sorry, I couldn't hear very clearly.
Can you hear me now?
Yes, I can.
Okay, great. No, I was saying would be lovely if you can go next, and I was also saying I feel left out of this KPMG Mafia.
I got that point. No, but seriously, I really wish I was there in person and to meet all of you. But my view on climate finance is the fact that, finance runs the world, right? But in that context, we've also got to see that climate is the foundation on the basis of which everything rests. In economics, there is a phrase called ceteris paribus, which basically means all things remain the same. I mean, certain things remain constant, and on the basis of that, we create all our projections, we create, what the future is going to look like, how our GDP growth, etc., will be, and so on. And one of the things within that, when you say ceteris paribus, it basically assumes that the sun will shine, the rain will fall, and we'll be able to grow things in the way that we currently do, we'll be able to move things around in the way we currently do, and so on. But if the climate changes, all bets are off, right? And so while we can put a number to it and say it's a $5 trillion transition, or there are people who are talking about $275 trillion, so it's whatever $1 trillion that we can continue to talk about. Yeah. But the fact is, business as usual is no longer an option, and finance needs to play a very critical role in enabling this transition.
Well said. Mr. Dhanpal, maybe we come to you.
Yeah, thanks a lot, and it's great to be here, and thanks, Neville, for reminding me of our past misdeeds. Yeah, and I see there are some others also in the audience, including Abizer. So let me just take a slightly different take, and I think, I wanted to kind of add a slightly wider perspective, even though this is a banking and finance conclave. Fundamentally, why has this question come up, and why has this question become such a urgent and important one to address from a global perspective? Is because the issue with climate is not just about weather, but it also has significant planetary implications. Because what a warming world does is actually change life on land, and it changes life in the waters. And that change of life on land and waters is likely to have repercussions which no weather scientist, no climate scientist has yet been able to fully model as to what could be that outcome. So there is almost a doomsday sense about what climate could potentially do to planet and our existence of humanity on the planet. The reason this has come up is because it's the fastest period since the time we started measuring weather patterns and temperatures. It's the fastest period in which the world has actually increased by 1.5 degrees on an average. That is in the last 150 years of industrialization than it's ever happened before in recorded history. And that is therefore another reason that we are actually entering into a realm where, again, we don't know based on history as to what's the likely implications of what's going to happen in the future. And to combine with all of that is the fact that there is, in my mind, the need and the reason to kind of therefore mitigate whatever is the carbon that is being, which is the main number one culprit for this global warming, is to mitigate the carbon which is actually being released in the atmosphere. Now, therefore, when we look at all of the science and we say, okay, what can one do about it? It's fundamentally about really trying to reduce carbon in the atmosphere. But at the same time, because temperatures are growing at such a fast pace, we also need to, as civilizations and economies, adapt and become more resilient to this global warming. Yeah. Now, we as an investor, when we started looking at this whole climate problem about 6 years ago, we realized that this is, for India, actually a very interesting, I would say, climate opportunity. And the reason I say that is because fundamentally India in the next 20 years is going to add 2 Indias to our economy. From where we are today, a $3.5, $4 trillion economy, we're going to be a $10+ trillion economy. And therefore, while we add these 2 new Indias, there is a real opportunity to leapfrog, the way we've leapfrogged the telecom, if you recollect the whole 90s, where we had 30 million landlines, right? And today we have over 1 billion mobile connections and landlines have actually cut down. There's a similar opportunity to leapfrog the entire energy as well as the transportation opportunity, right? By electrification of transportation and moving energy completely into a renewable, which is resource, where the resource in terms of wind and solar is completely free and available. Now, the biggest, I would say, movement for that, from an India perspective, is really to be able to drive something that actually can be, first delivering unit economics. Because India as a climate opportunity will only become real if we can actually deliver a climate positive solution, but in a way which is much more economically efficient than the current incumbent solutions that are there in place. Right? So therefore, innovation technology is a very key pedestal on the way in which we need to use that. And then India itself has a very unique business model, I believe. We are possibly the most unique testbed for actually all these climate solutions to drive scale through that, drive economics and actually drive value. So our endeavor as, Eversource, this business we set up about 6 years ago, was really to raise capital, which is risk capital, use that capital to build businesses across renewables, across mobility, and across larger circular economy businesses, which focus more on the adaptation and resilience, and deliver business models which are providing cost-effective, as well as competitive solutions to incumbents or consumers, basically, who want to kind of switch from the incumbent, climate negative technologies or solutions to the climate positive ones. It's been a very tough journey for us. And the biggest, I would say, challenge in this journey has been that all of the capital providers, equity as well as credit today, don't understand the climate problem as well, because there's very little history for them to evaluate when they're actually putting risk capital to work here. So that's the role we are in driving climate outcomes in a way we can generate positive returns and deliver, commercial outcomes to our investors.
I think really well said. Many important points there for the audience also to ponder, and takes me back to 15 years ago, the first investment I was working on as a newly minted business school graduate was Renew Power, where we backed, a man with a plan, Suman Sinha, to go and build what he envisioned to be one of the largest renewable energy platforms in the country. But it took way longer and a lot more capital, but then eventually turned very profitable and then diversified from wind to solar once the unit economics there also started looking attractive. So I think definitely large opportunity to transform at scale as we grow at this pace. I think, Neville, question for you. We see a lot of pools of capital getting excited about this climate opportunity in India. But a lot of the pools want asset-light solutions. They're chasing those when actually maybe the opportunity is equally in the asset-intensive space with longer gestation, larger amounts to be deployed. Any thoughts on, based on, all the clients you've been advising, how money is flowing and some of the lessons learned so far?
Sure. So, asset light for sure, from a private equity perspective, from any financier perspective, makes much more sense right now. But what is also equally true is that there are several large multinational conglomerates working in very, very heavy, intensive industries who are really working on this decarbonization agenda.
Yes.
And there is private capital that is actually flowing through to help these companies decarbonize. There's an important point that Dhanpal just mentioned. We must understand that consumption in India for India is a price-conscious market.
Yes.
Just because you say that this is a sustainable offering, nobody is going to pay you a premium for that. You have to be able to demonstrate that it's sustainable, but it's also at a better price point than what you can actually get. So there is money available, but you have to be able to justify saying that this is my business plan, this is how I'm going to go around doing it, and then there is tons and tons of funds available.
I think definitely something for the entrepreneurs to keep in mind as they build for Bharat. I think one maybe in the recent evaluations I've done of climate deals, three-wheelers, for example, on the EV side, total cost of ownership now is significantly better than the ICE alternative. And so we've started to see mass adoption there. But in certain other segments of the EV market where you maybe need a longer view as a consumer to go and make that decision, we're seeing slightly slower adoption. So to underscore what you said,
yes,
where if the financial value proposition is clear, then consumers are happy to take environment first.
Let me give you an
solutions.
example. If you just take the cold chain logistics, right? And if you look at the farming sector and saying that are they adopting sustainable practices over there, then do they have a good warehousing facility which temperature control, etc., etc.? Because we spend trillions of dollars in food waste after it's produced, right? Can we get this farm to the fork at the most economical, at the most sustainable option? It's a $53 billion opportunity just in cold chain logistics, if the projections for its growth. But unfortunately, what happens is that unless and until this whole thing works together, logistics costs in India today at 14%. Government says that we want to bring it down to 8%. But all of this will not happen unless and until you have warehouses, unless you have appropriate highways, e-highways that are coming up. All of those things need to come in.
The ecosystem needs to line up systematically.
Exactly. And there comes the part of saying that even if you have warehouses, can they use renewable energy? Can they make sure that they are being green? So all of those actually are very, very pivotal in this process.
Absolutely. And as we think about ecosystem transformation, Namrata, maybe I can request you to come in. AI is topical. It's on everyone's minds. And I'd love your views on AI and ESG. Obviously, AI has the ability to drive efficiency at scale. It's also extremely energy consumptive. Would love your thoughts. I know you've been spending a ton of time thinking about this specific aspect of this nuanced problem.
Certainly, Lavanya. So, in most conversations that I've been having with boards, almost 90% of ESG conversations degenerate into AI. So, you begin with ESG and then you go read somewhere and then suddenly, but what about AI? Now, that basically means that there are two big disruptors that are there in the world today. One is ESG, which is basically, getting people to wake up and think about different aspects that might change in the future. And then the second bit is the way AI is accelerating. And AI and ESG are not independent of each other, they're actually impacting each other. Because the use of energy in AI is extensive. And that in turn can lead to climate change. On the other hand, there are several AI-based solutions around climate, around biodiversity, around managing our oceans, helping us solve many health-related issues, having a positive impact on people's daily lives, and better forecasting overall in terms of the changes that are happening in the climate, helping us, figure out what are the weather patterns and how they are changing, how things are likely to happen. So there is the good and the bad and the intersections that are happening at the moment. Now, for a business, they need to actually look at where these trends are going and how will it impact them. Also for investors, they need to then take a horizon which basically says what are the consequences of my investment and how will it get impacted either adversely or positively because of these changes. Therefore, the transition and the investment decisions really become very complicated when we start looking at these things, and the metrics for success, even if we define them right now on a piece of paper and say that this is what the next 5 years are going to look at, we may end up with different kinds of surprises because this is no longer business as usual. There are many impacts in the world around us that are impacting business, geopolitics aside. So, AI and ESG are big disruptors.
Thank you so much. I think very interesting perspective, and also interesting to note how dominant this is on the minds of CEOs in the boardrooms you occupy. Dhanpal, maybe coming back to you, given the pace of financing has not really matched the urgency of the problem that all four of us have alluded to, how do you view the role of blended finance, specifically in addressing the barriers we are facing? And are there frameworks that you think could help unlock the full potential of blended finance in this country, which, as Neville said earlier on, is raring to go? Apna time aa gaya. We are ready from a growth perspective, but we should grow responsibly, sustainably, take the planet and everybody most vulnerable along with us on that journey.
Yeah, Lavanya, I think the reason capital is so important in solving this climate problem is because by and large, what we are seeing is across, if you look at energy transition as an entire, the value chain, and if you look at even transportation, electrification, these require significant amount of upfront capital investments. Because what you're largely converting is what is a CapEx model into an OpEx model. So you're selling, green gas, you're selling green energy, you're selling, green services, all of the kind of stuff, mobility again from a green perspective. And therefore, the issue becomes that you're basically requiring to spend anywhere between typically 2 to 4x of what an equivalent incumbent solution would cost it. Now, also attached to that is the fact is that we are talking about a complete change in the ecosystem, right? When you move from your fuel basically at a gas station to literally a large component of the fuel, the battery being in an electric vehicle and therefore being costed upfront, you are not going to use diesel, but you're going to use basically electrons, right? Green electrons to charge those batteries. Now, therefore, the delivery mechanisms change, the way people consume it, right? Rooftop solar is a great example of now how you're not just a consumer of power, but you can actually generate electricity on your rooftop and even, right, upload it to the grid and sell it. So there are all of these changing business models which require us to not only first have the technology completely stabilized and commercially viable. Two, the business model which is being deployed to deploy these technologies are new and therefore being able to kind of underwrite that. Three, the ecosystem development. So if you're a green, energy generator, you sometimes also have to build the evacuation. You also have to make sure that the consumer has a smart meter. So all of those ecosystem changes, or even an electric model, basically charging infrastructure that needs to be put into place, etc. So you're developing and investing in broader ecosystems, not just purely in that particular service you're offering. And four, really, as a result of all of this, you need to therefore have the ability to take that risk, put that business over a 3, 5, 7 year period, scale it, and deliver economics. Now, therefore, credit typically is the least risk cost of, part of capital. And equity, while it has risk, it wants measurable, understandable, underwritable risk. And that's where the role of really blended or what we call concessional capital really starts playing a role over here. And that is what we define either as first loss capital, right, or return enhancing capital, which you can actually put into the capital stack. So we've done it with our first fund. Our first fund actually has a very innovative structure where not only have we raised equity capital from all our LPs, but we've brought in certain LPs providing us a first loss capital in the fund structure itself, where all non-first loss capital providers are actually getting risk mitigated to the extent of that first loss capital which is being provided. It's kind of like if you think about any kind of a co-lending structure in a banking model, right, where someone who's underwriting it and the bank who's supporting that underwriting is actually getting some sort of a first loss cover from that participant lender. This actually allows us to take risk which typically in a classic commercial construct is difficult to take. At the same time, create the business and the business models which allows us to prove that what we've underwritten is something actually that can be delivered. So we've done this quite successfully in several businesses that we own today. And that, I think, is what gives people the comfort, right? We are able to, on the back of $80 million of concessional capital that we got into our fund, we raised a $750 million fund.
Wow.
And on the back of that $750 million, we raised co-invest equity of $600 million and another $1.3 billion of debt, which went into all of these business. So that $80 million of capital actually created a 46x mobilization of commercial equity and debt to go into businesses which are climate positive. So that's the, I would say, magic or the accelerating effect.
I think fascinating. And it feels like from the first wave of climate investing in India, there are some lift and shift solutions from other parts of the world, but some that have had to be reimagined for the market we're in. Neville, would be lovely to get your thoughts on the kind of innovation you're seeing on the climate side that is specific for Bharat versus what has worked elsewhere that continues to work here as well.
Lavanya, more than the innovation, the frugality of the solutions is actually what catches my attention.
Interesting.
So the typical Indian mindset of Jugaad actually tries to do things in a much sharper, faster fashion very, very quickly. So if you pick up any sector, you take green steel, you take the coal fusion is to coal getting into the value chain. You look at water treatment plants, you look at all of those, the cost of equipment that is being made to actually manufacture or to help in carbon capture, emissions, etc., far, far lower than what you can get from overseas. So that itself, the whole engineering portion about how does machinery actually work to decarbonize, to reduce carbon emission, to do X, Y, and Z, actually is far, far superior in India as opposed to several parts of the world. You might find a small player, I mean, let's take an example of Worry, right? Great example. They just came up with rooftop solars and they've really captured a large part of the market. Up till now, it was, when they started off, when I met the management, it was just about nascency stage, even for the European markets and the US markets. But they've really gone ahead and pushed.
So this leapfrogging is starting to become more evident in this, last decade when...
I think the part that we probably need to get a little better is competition, and I think the earlier panel also mentioned about it, our cost of manufacturing in terms of scale, when we compare it to China. If we can get that cost of manufacturing lower because of scale, I think we have an unbeatable force over here.
Makes a lot of sense. And as we think about measuring impact, Namrata, I would love to come to you. Right? There's reporting and there's reporting. Sometimes it's an obligation. Sometimes that's the only way the providers of capital get to see this multiplier effect of what it is, they have supported. Would love your views on, one, just how ESG reporting is done now, and two, any sort of thoughts on interesting new ways in which the users of this green capital can do a better job, communicating its impact and measuring it, of course.
So, see, there is a lot of conversation on ESG rules and regulations right now. And it's just accelerated. So at the moment, there are 1,114 ESG metrics. Wow. Right? There are more than 535 ESG regulations across the world. So companies are asking, do we run our company or do we just sort of just sit and solve for things that are beyond our control? So, even if an organization has positive intent, they can't possibly look at everything that needs to be done. Because there may be unintended consequences for the things that they're actually doing. I mean, no one really imagined that, this many plastic bottles, the inventor of the plastic bottle possibly never imagined there would be this many plastic bottles all across the world, littering our oceans, littering our rivers, or plastic bags, right? So it's not just the materials that are being used that are a problem, but in a way, if you start looking at things really deeply, it's how we use materials, the way our businesses are structured, and the fact that a lot of products are designed in a way that is no longer suitable for today's world. So Dhanpal really mentioned something really interesting when he said that, where are the opportunities? To my mind, every single thing all around us, I mean, the room that I'm sitting in and wherever you are, just look carefully. Everything needs to be remade again for today's world. Everything around us needs to be questioned in terms of the materials that we are using. So in terms of impact, social impact, environmental impact, and everything else all around it, we can actually take simple products all around us and start saying, what is the social impact of creating this product? So for example, just a simple pencil, right, has 700 components in its supply chain, unique components in its supply chain. That's just a simple pencil. So if we now, one can start saying these are massive problems, no one company can solve it, but then wherever there is a problem, there is a business opportunity as well. So one can start saying that these are value chains that need to be redesigned. If a value chain needs to be redesigned, somebody somewhere can think of a different way of doing the same thing, driving value to the customer, but then in a different way. So there's a lot to be done.
I think, picking up a thread from what Neville said before, you have to ultimately deliver value to the consumer for you to then capture that value as a provider of that product or service. Otherwise, I think in the Indian context, mass adoption will continue to be hard. Mr. Dhanpal, I'd love to come back to you. Obviously, renewable energy or energy transition and mobility are the two big sub-segments within the whole climate space that have seen a lot of capital flowing in. As someone who's always looking out for the next, new set of ideas, what are you seeing entrepreneurial activity in? What are the other themes and big sub-segments that we should look out for as we think about, the forward?
Yeah, I think Namrata kind of touched upon, right? I think climate is becoming more of a horizontal opportunity rather than a vertical opportunity. And I think a lot Namrata talked about is on if you think about the CPG side of the business, right? They all need to transform in the way they produce products which are going to be consumed by consumers. But if I put that, because that would then get into a completely different domain, if I purely look at it from a climate solutions perspective, which is how do you reduce mitigation, or how do you mitigate carbon emission, it's really thinking about the replacement of all kinds of fossil fuels with clean energies, right? So as we know that hydrogen is going to be the next big opportunity, but today the problem with hydrogen is that we've yet not been able to either build these electrolyzers at a cost, which is cost effective, and at the same time we've not been able to get our energy production, right, green energy production down to a level where we can produce a kilo of hydrogen which can compete, green hydrogen which can compete with gray hydrogen, right? So there, I think yet scale effects have to come into play, but we've seen that very clearly work where it's worked in, say, solar panels, for example, where it's worked in batteries, for example, LFP batteries especially. We will see similarly I think it's not like hydrogen technologies are new. They're very, very old, right? These are like in the, I would say, early 20th century technologies. But the ability to bring in capacities at scale so that you bring down unit costs and deliver that. So that, in my mind, is going to be the next big opportunity. It's also helping India solve not only its energy security, but also becoming a large exporter, because I think what we are naturally endowed with is massive amount of solar, which is free, right? And we can use those solar energies to actually produce hydrogen, convert into green ammonia, and actually becoming a fuel which can be transported to economies in Europe and economies in the Far East, such as Japan, etc., to actually deliver as an exports commodity. So it's many ways what US did with shale gas, right, production, and have becoming import or kind of self-sufficient in the energy value chain. I think India has that opportunity to do it. The problem again is that we yet don't have, there's a viability gap, and we yet need to kind of start building those assets at scale. I think China does things very differently. They take a view on a particular technology, particular subsector, and they will just invest at scale, where they are not going to be looking at anything other than making sure at what cost can I start replacing demand, right? And to Neville's point, a company like Vari today, it is actually already one of the most efficient producers of solar panels outside of China. But the problem is China gives such subsidies. Someone told me that the cost of setting up a plant in China is 0.6x of a cost of setting up a plant in the ASEAN region or in India. So you are really dealing with geopolitical kind of, I would say, decisions, which then drive how do you need to, develop your local economy, and how do you use that to essentially develop your local industries.
So absolutely, I think you neatly led me to where I was going to go. So Neville, I was going to ask you for your views on subsidies and their role in catalyzing both investment and consumption. So we've seen, for example, what the FAME subsidies have done, what the PLI for indigenous battery technology has done. Would love your views on what you're seeing, because you also have large, corporates as your clients, in addition to, of course, your broader set.
See, the area that I think, and which is coming through very shortly by the government, is on carbon capture. I think that is going to be one significant game changer for India. This whole policy around CCUS is going to be a big game changer. The other one is around batteries, because battery storage, because you can generate, we have 165 gigawatts or 130 gigawatts of renewable energy right now. Plan is to go to 500 gigawatts, and we have about 120 in production. So you can produce all of that electricity. You need to have somewhere to store it. You need to have a carbon market. You need to have a renewable energy trading platform. So you need carbon capture as one crucial element. You also need a lot of incentives in the green steel. You need to look at the steel sector very, very carefully and really push for green steel. And one other area which I find interesting is around the e-waste recycling. I think small businesses have started catching up over there, and they're doing some pretty innovative, pretty interesting work. It's tough because it's a corporate, well-established corporate trying to work with the unorganized sector. But those are some of the places where I think the government really needs to give it a fillip and push.
Very interesting. I'm being told that I have to wrap up shortly. I got a nice little warning here on the board. So would love for Namrata and then Dhanpal to give your final ask from a policy perspective, or just, some reviews.
Yeah, I think capital, I think
Show us
RBI,
the money.
RBI needs to come up with a very, very clear, cogent policy on climate finance. I think so far it's really it's playing at the edges. Banks themselves have taken the initiative, financial institutions have taken the initiative to, lend significantly to the solar industry, because that clearly is now, proven commercial economics, very low risk, etc. But I think there are many, many, many other sectors in climate which yet need capital. And almost like how directed lending happens, right? When the policymakers come in and work together to say, okay, I need this sector to be kind of mobilized. that kind of direct lending needs to happen in India, right? Where the risk takers, who are the lenders and the investors, are taking, I would say, measured risk, but there is someone who's willing to back them, right? In the form of like what's happened with, I think, the PPP models and e-buses, the PPP models in solar. I think that's been a fantastic fill-up to actually catalyzing a lot of capital into the climate space. So I would think that there's a great opportunity right now between the budget and the new RBI governor to really put their heads together and come out with something transformational.
Absolutely. Your 46x impact of the blended finance model is still, seared in my brain. Namrata, we'll give you the last word. Would love to have you come in.
I don't know whether you've seen the movie Everything, Everywhere, All at Once. So that's really what we need in terms of climate. We need the innovators, we need the policy makers, we need capital, and we need all of them to talk to each other. To me, that's really what is needed. Everything, everywhere, all at once.
Love it. Well, the RBI has said, 2.5% of annual GDP till 2030 at least to get to our targets. So let's hope we as an ecosystem work collectively to be worthy of attracting that. Thank you all so much. It's been an absolute privilege and pleasure to be here.
Thank you so much for that insightful discussion. I would like to call Mr. Abizer Diwanji, member BFSI Committee, Bombay Chamber, to present mementos to our esteemed panelists as a token of appreciation. Our moderator, Ms. Lavanya Ashok. Mr. Dhanpal Jhaveri. And Mr. Neville Dumasia. Thank you so much. Requesting for a group photo. This session, I invite Mr. Abizer Diwanji, founder NeoStrat Advisors LLP and member BFSI Committee, Bombay Chamber, to please deliver the vote of thanks.
Thank you. I'm just between you guys and lunch. I just want to spend 2 minutes thanking our sponsors, Aditya Birla Capital, Bank of Baroda, Ashwin Seth Group, as well as Access Mutual Fund for making this conference happen, frankly. I want to thank Mr. Vishwanathan, coming all the way down from Bangalore and actually giving us insights. Basically telling us something very simple. The cost of credit is going up and credit is not going to the right places. And how do we make sure credit does go to the right place is what the next panel was, which was actually how do we fund India's $5 trillion economy. We had very interesting insights moderated by Lata Venkatesh, which was very good. And of course, we had a host of speakers from private credit to banks to NBFCs who basically came and all said how they'd want to help India grow into a $5 trillion economy. And then, of course, Lavanya took over along with Neville, Namrata, and Dhanpal. And they spoke about how climate finance is going to impact. And of course, this 46x layering is clearly in everybody's mind. It's a very interesting structure. I was actually telling the banker that why doesn't Dhanpal only raise the 80 million and then go to the banks for the rest of it? That cost of capital may be cheaper. But he said, well, banks are not geared to do this. That's the answer. But the common thread across everybody, except of course Mr. Vishwanathan, was let the whole ecosystem develop and financing will be available. So I think the underlying theme is there is finance available for the right ecosystem. And I think the larger government objective, maybe from the budget itself, would be to let's try and build an ecosystem so that financing is viable. Financing will never lead the way to create an ecosystem. And even if there is a 46x leverage available, the 80 million is the only money you will get which is willing to take the risk. The balance money will only come if the risk is mitigated enough. So I'd like to thank all of you for participating again and look forward to lunch. Thank you.